Thank you, but you might want to hold on to your applause for another 90 minutes. Good morning, everybody. The expensive seats are up front. So for those of you in the back, ordinarily, if you were at an NFL game, I mean, you want to sit up front, for the benefit of the big bucks that you have to pay to get in. That being said, you are in for a treat today. As good as yesterday's agenda was, I think today's will match up very, very well in terms of information and in terms of things that you can take back home to the office. And we always kick it off on day 2 with our economics panel, a perennial favorite, as Ian said. And I mean, you all know about the reputation of economists. Exciting, good-looking, even-handed or two-handed or two-fisted. And we have a terrific panel. And I've been fortunate enough to work with all 3 of these individuals over the course of years and years and years and years, and we won't count them because we want to keep our shoes on. Okay, that's intended to be humorous, but you probably haven't had your 3rd cup of coffee yet. Anyway, without further ado, our 3 chief economists, starting things off with Vice President and Chief Economist at Eaton, Jordan Vickers. Then we will turn the mic over to Senior Vice President and Chief Economist of the American Trucking Association, Bob Costello, and then our own dear Chief Economist, David Teolis. So once again, without further ado, Jordan, take it away. Thank you.
Great, good morning, everyone. Look, 8 a.m. econ panel? Wow, you must really want to get the bad news out of the way early, huh? So Jordan Vickers, Chief Economist for Eaton. Eaton is a $25 billion global manufacturer of everything from truck transmissions to electrical equipment that ends up in AI data centers. And to that point, the title of my presentation this morning is AI keeping us out of a recession? So we're going to ponder that question together. The reality is when we look at the economic data, there's clear slowing in the economy in the first half of this year and into the 3rd quarter even. We look at data on the left here. This is real GDP, 2-quarter average, as well as consumer spending. And you see the last 2 years we've seen growth almost towards 3%, and that has slowed down to a measly 1% in the first half of this year. You also see it very noticeably in the labor market, and this has gotten a lot of attention in the last few weeks with the July employment report, which was so bad that the Bureau of Labor Statistics chief was fired. But in July, we saw 73,000 jobs added, but more importantly, the last 2 months previous were revised down close to 0. Okay, so we've seen a dramatic slowing in the number of jobs added. We think a large portion of the slowing in the economy and in the labor market is due to immigration. We also see that in the data. If you believe the data from the BLS, about 1 million foreign-born people have left the country year to date. So that's certainly a drag. As bad as this data may look, it's not unexpected though. Given this immigration story, as well as just natural demographics of a large baby boomer population that's still retiring, coupled with a Gen Z that is not as big as the baby boomer population coming into the workforce, we really only expect, even in a relatively healthy economy, for somewhere around 20 to 40,000 jobs a month to be added, given those demographics. So not totally unexpected. And we're also seeing not a whole lot of layoffs. So despite this slowing in hiring, it's more of a no hire, no fire labor market than anything else. And clearly, as many people in this room are feeling, there's many big industries that are already in recession and some that have been in recession for some time. We look at the housing market on the left here, housing units under construction down 20% since 2023. That's not improving. You look at for-hire trucking, down 15% since 2022, obviously what we feel in this room. More recently, tourism, down 4% this year. You could also throw on here manufacturing, which has been teetering on recession, in and out of recession for the better part of 3 years as well. So some very big and key industries not doing so hot. So what's causing this? All right, we put six things down here. We list them in terms of our order of what we think is causing them. Immigration, I already mentioned that. That's key in our view. Restricted monetary policy. So we'll talk a little bit more about how the Fed has kept interest rates high for long. Stretched affordability. This also goes along with the fifth one here, which is sector-specific cyclical returns following COVID, right? So industries that had big booms in the COVID years and now are sort of paying back that. Government spending. So we saw initial returns from DOGE, probably underwhelming, but we've also seen the government hold back on some of the Biden-era stimulus funds, and that we think is slowing as well. And then lastly, I think my team is in a minority here, of economists, but trade policy is certainly a negative, but probably not as big as many economists think it really is. We're just not seeing a huge impact from trade, both from the uncertainty channels as well as the inflation channels, at least yet. Maybe that's to come, but at least so far, that's only a minor impact in our view. Looking at Fed policy a little bit more closely, right? So the Fed's in a tough spot here. We have inflation that is still too high, and I would note that's more so on the services side of the economy, services side of inflation than the goods side, so it's not all about tariffs. And at the same time, the labor market is slowing. So should the Fed be cutting preemptively here to avoid a further slowdown in the economy? Or should the Fed sort of stay at high rates to sort of hold off this rising inflation and still high inflation? That's the sort of conundrum that they have right now. Our view is that they're going to take the side of cutting rates. We believe that the market is probably correct in forecasting about 3 25 basis point cuts for the remainder of this year. And we think they will get back to a more neutral stance on policy in the 3 to 3.5% range by sometime in the middle of next year. So with all this negative news, you might say, well, all of these industries are already in recession. Why isn't the overall economy in recession? What's going on? And the reality is we're in one of the most ferocious investment cycles in terms of generative AI investment that we've ever seen. Data on the left is from the big 5 hyperscalers, Microsoft, Google, Amazon, Meta, Oracle, in terms of how much they're going to spend on CapEx this year, most of that going into data centers, power, and the IT equipment associated with that. This year, they're expected to spend over $400 billion, and that's just the big 5. There's a lot of ancillary companies that are coming along with this as well. And from an Eaton perspective, we're not seeing that slow down really at all. That's also evident in the semiconductors market, where historically a very cyclical market, when we see slowdowns in the economy, semiconductors really pull back. Not seeing that at all this time. And to put some scale behind this, what's interesting is if you look within the GDP data, just in the first 2 quarters of the year, this is two quarter data, you look at contributions to GDP growth. The AI, data center, software, IT equipment, and power contribution to GDP was over 1%. Now, to put that in perspective, those sectors only represent about 7% of GDP. And yet, at the same time, they contributed more to GDP growth in the first half of the year than all of consumer spending combined, which represents the vast majority of the economy, 70% of the economy. Okay? And it's also evident in the stock market, right, where you see the Mag 7 or the companies that are heavily tied to this AI investment boom, 1-year returns, 35%. While if you look at something like the Dow Transports, trucking, airlines, and rail, right, only up 2%. And you might say, well, that's just speculative, but it's not. because that's where all the earnings power is as well in the stock market. So you look at the earnings growth from these types of companies, regularly 20, 30% earnings growth, while the rest of the companies in the S&P 500, marginal growth at best. So where do we go from here with regards to AI? You can read the slide. I'm not going to go through all of this, but we have 3 scenarios that we've outlined and we think about regularly. We're big believers in AI, so we'd like to think the first one is the most likely scenario, but anything can happen with AI, and so there's a lot of uncertainty around where this all ends up. If we look at sort of an AI-led expansion, which we think is most probable, we're going to continue to see this investment boom. We're going to see strong productivity gains. That's going to result in continued growth in GDP, and we think there's a chance that reskilling and growth in AI-adjacent fields will help the job market. Flip side of that is maybe an AI displacement scenario where you have AI is strong, but is so disruptive that you have job losses that are not fully offset by productivity gains. And you might have societal issues with job losses and all of the returns from AI going towards capital holders instead of labor. Then thirdly, maybe an AI bubble collapse where AI just is not what it's hyped up to be. It reaches its technical limits, and probably this AI investment that I've been talking about it will roll over and potentially lead to a recession in the broader economy. One other narrative that we heard a few yesterday on the panels talk about this narrative of, hey, tariffs and the uncertainty from tariffs are really causing firms to hold back on CapEx. We're just not really seeing it in the macro data that we look at. Certainly there's anecdotes of that. Certain industries, trucks right now, we're seeing that. But in the macro data, it's just not there. Two of the charts that I show here is non-residential building and infrastructure construction starts, hit an all-time high in the month of June, all-time high in the second quarter, growing 9%, and that's after Liberation Day, right? So not a story of weakness there. You look at similar data that comes from the government, Census Bureau, factory shipments. So U.S. factories, shipments of capital goods have actually accelerated through the summer, right? And so not seeing it there either. 7% growth in the second quarter. Even if you strip out big clunky things like aircraft and defense equipment, still accelerating. So maybe tariffs will eventually matter in the aggregate, but we're just not seeing it today. And I can tell you, into the month of July, we're not seeing it in some of the data we look at as well. At Eaton, we track on the construction side big billion-dollar-plus mega project announcements, and July hit an all-time high. So we're not really seeing that in aggregate. So where do we go from here in the economy? Our base case is one of modest growth, more of a muddle through. We peg the probability of that at about 45%. Within that, we're expecting gradual interest rate cuts, maybe faster here towards the end of this year, but then more gradual next year. And then the economy will remain resilient, driven by this AI investment with modest cyclical recoveries in some of these beaten down industries. Inflation will remain above target, but will be held in check enough where the Fed can do these gradual interest rates. We're also becoming, I would say in the last 2 months, more optimistic that there is a case to be made that next year could be a reacceleration year. If the Fed does cut dramatically down to 3.5%, and really starts boosting the housing market, manufacturing, these cyclical markets could recover strongly, as we heard, potential for that yesterday. And with that, reacceleration, there would be a hope that policy becomes a little bit less chaotic as well, and we can have some resolution on trade. We're not totally dismissing the case that a recession is probably, the odds of a recession are above average though, just given the slowing that we've seen in the economy. And the concern here is that the Fed is late and will take the inflation mandate more serious than the slowing mandate and not do as many preemptive cuts as maybe they should. So that's where we sit on the economy. Here's our forecast if you're interested. We're expecting about 2% growth next year, inflation to remain elevated, unemployment to tick up slightly, and then manufacturing, housing, and business investment all to post some, again, modest growth next year with some upside in that more optimistic case. So I'll leave it there.
Thanks, Jordan. Good morning, everyone.
Good morning.
Pleasure to be here. It's been a while. I got one quick funny story for you. So I think the last time I was here was 16 years ago. My daughter just turned 16, so she was just an infant. And Ken, would go out to these estate sales and give the speakers a nice gift and so forth. And so I had to run as soon as I was done, and he came up to me. He's like, "Bob, you got a brand new daughter. Here's some wooden blocks that I got at an estate sale, and I want you to have them for your daughter." I'm like, "Oh, Ken, thank you so much. That's so nice." And I go to Indy, and I go through I take everything on the plane, and I go through the metal detector, and they're like, "Oh, you're a random search." And so they say, "Hold out your hands," and they swab them, and they put them in the machine, and it goes nuts for explosives. And I'm like, "What?" And so they're like, "We got to take," and I'm late for I'm running to get this plane, and they take everything out of my suitcase, and they're swabbing it. Those blocks must have been in a barn on a farm and had fertilizer all over them, and it tested positive for explosives. That's a fun story. So I haven't had that one happen before. All right, so thanks, Jordan. That was a great overview. I'm not gonna. Listen, I have a lot of thoughts as well as the macroeconomy. I am not gonna do that for you today. I'll be more than happy to take questions on that later. But what I want to do is focus in on the trucking industry to give you sort of a perspective of where we are with that. And I think in order to get there, let's look at where we've been. Now, for you fleets, this is ugly, right? You heard it over and over yesterday. This has been really, really tough, and it has. But if you look at the numbers, it really starts to come into focus. So here's what I did. I've taken the last 3 cycles for the truckload sector. This is data we collect at ATA. Every month we go out and we collect from for-hire motor carriers, loads covering millions of loads, so data covering millions of loads, billions of dollars in revenue every single month. And I can take that data, and what I did is I started it at the peak and followed the last 3 cycles down. So the blue was the first one. That was after the tech boom of the late 1990s. And then what we saw there, the Great Recession is the red, and then the latest cycle. I ended it in December 24. Hold on. I'm not saying it was over then. I'll show you some more stuff, but I ended it last year. And and then there's revenue per mile excluding fuel surcharges. Same sorts of things. And what you see, if you talk to fleets, so many of them will say, this was the worst cycle we had ever seen. Well, here's why. It wasn't as deep as most cycles at all, but it was the duration of it. So instead of ripping off that Band-Aid, it was a slow pull on loads, right? On rates normally don't go down as much as loads. This time, they did. Yes, they boomed during the pandemic boom. But on top of that, right? And I'll get to more on this in a minute. And this is very important. And when you look at this, add in the extremely high cost inflation that this industry went through at the same time, and it's a triple whammy, right? And that's what happened and why it was so bad for them. Now, for the LTL industry, listen, LTL does see some pretty steep declines, right? So truckload carriers haul more manufactured goods, but it's a higher percentage of the LTL business. And so they have seen some pretty steep declines in volumes over the years, although you see their rates do not, which is probably why some truckload carriers are trying to buy LTLs, right? Because they don't see that drop in rates. But the other thing I will add on here is there's a 4th cycle. So truckload had 3 cycles over that period. LTL had 4. What was that added cycle? Well, it was November of 18 to June of 19. What was going on then? Not to this scale, but tariffs, right? It was when President Trump the first time put in tariffs, and it absolutely had an impact on the LTL business. All right, so let's go with where we are today. So this data on the left, this is just truckload. This data on the left is loads for the contract loads. So that data I said we collect every month, covering millions of loads, there's some spot market in it, but it is dominated by contract freight. So I think it's a really good, sort of just saying that's contract freight. And then you have spot market on the right-hand side. What I want to focus in on here is on the left, right? So in June of this year, we were still down almost 2% year over year, second quarter down 1.4%. And so you could, I said that the cycle ended in December. I didn't, I just took it through December. You could argue that indeed it has not, okay? But one thing I want to point out here, see that big drop on the right-hand side? That was December, all right? Now you heard yesterday from fleets, and I totally agree with them, that December wasn't too bad. Like the fleets were getting more optimistic late last year, early this year. So how could that be if you had that big drop? This is seasonally adjusted, by the way, but I don't think the seasonal adjustment factors do a good job in recognizing in the freight market, this past Christmas fell on a Wednesday. Talk to almost any fleet. That is the worst day of the week for Christmas to fall on. Because what happens is the drivers don't, it's on Wednesday, so they want to get home. Don't blame them, right? Christmas on a Wednesday. And then it's like, well, it's already Wednesday. Do I really want to go back out, right? And so I think freight, and then New Year's was sort of the same deal. So what I did, okay, was I sort of just smoothed that out for you. Still low, still didn't recover. Maybe you could argue February wouldn't, that's the high point. February wouldn't have been quite as high. Okay, I'll give you that. But we could even bring that down. And you still see, while it wasn't strong, at worst, we were just sort of bumping around, flattening out. Until March. And then loads start to fall again. And I will argue that, I agree, I think we are in the early stages, the early innings of the impact of tariffs. I think we still have a lot more to come from that. But I would also argue that it's already caused some problems in the freight market. Along with, as Jordan pointed out, a general slowing of the economy. Consumers are not, are scaling back some. Although there's evidence that I talk a lot about spending on goods versus experiences, and while we have seen experiences have definitely scaled back, and I always tell fleets all the time, I'm like, listen, we got to look at the good side of the economy. You're not putting services in trailers, we put goods in trailers. That's what we need to really focus on. So again, for illustrative purposes only, I actually think things were not that bad, especially late last year when you adjust for the timing of Christmas and New Year's, and early this year, but things have come back down. Now, earlier this week, that goes through June, earlier this week, we did report truck tonnage. It's not my preferred metric. I like to look at loads. Tonnage, though, did come up a little bit. So I think you can assume here for a minute that July will come back a little, not a lot. And we're still at pretty low levels, right? So this is where fleets were getting a little bit excited, and then this has happened, right? And this is the frustration. And of course, if we go back, the spot market is just bouncing around the bottom pretty much as well. LTL, again, different animal, but this is down both in shipments and in tonnage. So that's on the volume side. Where I've been spending a lot of time talking to fleets is on the supply side, because as you heard Jordan earlier, I totally agree. I don't think the economy is going to snap back enough to really cause a surge in demand. So I think in order for the correction to continue in the trucking market, it's got to be on the supply side. And so if we do that, I want to talk about a few different pressures. fleets have been on. I guess, and I didn't really put any charts on this, but we all know, because we all know it, they've been under rate pressures. And rates have started to come back up a little bit. And you heard that earlier. I think yesterday one of them said, low single digits. I agree with that. I think that is indeed where we are. But it fell quite a bit. And again, that was, after really high levels during the pandemic. But what has happened is we've been under also the second pressure would be cost pressures in the industry. So the American Transportation Research Institute does this interesting operational cost of trucking every year. This includes everything, right? Truckload, LTL, specialized. But look at these numbers that they put out. By the way, I take fuel out of these numbers because when I look at revenue per mile with our data, we ask the fleets to not include fuel surcharge revenue. So I want to do an apples to apples comparison. But look at 21, 22, both around 10% annually increase in cost. 23 was really high at 6.6. Yes, it came down in 2024, but the cumulative effect of that is huge. So much so, what I did was I took our data for the truckload industry. I took our data on revenue per mile. That's the red bars, okay, excluding fuel surcharges. I took the data I just showed you, and I set them equal in 2019. Of course they weren't equal in 2019, right? I'm not saying that costs and rates were the same, no. But I'm saying let's do that, and let's follow it over time. And at first, we get the boom of the pandemic, and they're moving pretty much in tandem. And then we hit a high point in 2022, and then freight starts to go down, right? Because people then went from buying all these goods because they weren't traveling, they weren't going to the movies, they weren't going to sporting events or concerts, and then they just, switched and they went and said, I bought all this stuff, we fixed up the house, we did all this stuff, we weren't traveling, now we want to travel, revenge travel, right? And do all these experiences. Freight goes down, but our cost didn't. And when you get to the end, there's a 26% difference. Completely unsustainable. There's, so I would argue, I'm going to show you in a minute, I would argue that I think more capacity has come out than people realize. And on top of it, I think more is going to come out. So let's look at that. So I guess before I get there, here's the challenge. I wish, I really do, that there was one metric I could point to. And I'd be like, this is how much capacity is in the industry, right? This is what it doesn't exist, folks. It just doesn't. What you have to do is you have to take all the different pieces of this puzzle and try to put it together and draw some conclusions. So here's some things I look at. Again, I'm going to go through this fast, but you've got the slides and so forth. FMCSA, Federal Motor Carrier Safety Administration, puts out the number of people with operating authority. Do I believe these numbers? That there were really in June of this year 330,000, 439,000. No, I do not. But here's what I do believe. I believe the trend lines. Right? So I think that the trend shows it's come down. Revocations, right? It's improving, but it's so much higher than the average it's been. Another point that says fleets are coming out of the system. Carriers are coming out of the system. Then we can look at employment. Now, here too, there's some challenges. But what I like to do is the Bureau of Labor Statistics, every month, puts out this data on production and non-supervisory employees. In the general freight, long distance trucking industry, which includes, just for-hire carriers, truckload and LTL, this is a great proxy for drivers. It's not only drivers, right? Because it's more than that. But in our industry, the vast majority of these types of workers are indeed drivers. So I think it's a great proxy for that. And what you can see is this has come down. It does not include independent contractors. this has not only come down from recent highs in 2022, it has also come down from pre-pandemic highs. So this suggests that capacity is leaving. And then we can look at the number of tractors being operated out there. So when I said we go out and collect that data on millions of loads every month, we actually ask them, how many tractors, company tractors, did you start the month with? How many did you buy? How many did you lease? What did you get rid of, right? And we can get a net change, and we also do that for leased on ICs. So that's the company tractors is the blue line, the IC line is the green one, and then the blue dots are quarterly data for just the publicly traded carriers. All of these suggest down from recent highs, down from pre-pandemic highs. So one might say, well, why aren't we feeling that then? Because demand has not come back enough. So one of the two things have to give. We either need a little increase in demand or we need more supply to come out. But I'll tell you this, when we have one-off events, storms or road check or something like that, guess what? It tightens up pretty quick. And then it just goes away because there's not enough of it that has happened. So the other things I want to bring up is I think there's a lot of fleets on the brink. I really do. And one of the reasons I draw that conclusion is A, we know what's going on in terms of fleets saying they want to be bought up and that they're for sale and so forth. But also, if you talk to, and I talk to fleets all the time, I talk to my members all the time, you talk to the carriers that have leased on independent contractors. And you're like, hey, how are your ICs doing? Oh, they're good until they have a significant maintenance event. And then I'm like, well, what happens then? Well, then they're done. I'm like, done? And they're like, done. Like, they are out. I'm like, what's significant? $8,000, $10,000? Like, they laugh. No, like $1,500, $2,000. They have no cushion. So I think you have a lot of those on the brink, right? The other thing is that I think that has happened and why supply, so I've been asked already today, do you believe this narrative around banks not repoing some of these trucks and so forth? I absolutely do. I talk to those folks. It has been happening. But on top of that, the other thing that has happened this cycle, probably more than any other, all right, is so, with the technology out there to get a load today, right, it is super easy. If you take a load to Atlanta, it is not hard then to get a load. I remember, I've been doing this so long, I remember going to truck stops back in the day and they're all sitting there waiting to get on payphones to talk to brokers to get a load. You sit there for a couple days, you don't last very long, right? But now they get on their apps, they're able to get a load. They're probably losing money on that load, but what do they have? They have cash flow. And that's never really happened before, not to this extent at least. And so I think that has also saved some of them. But it's only a matter of time until this catches up. And that they eventually, so if the narrative is the economy's slowing enough that volumes, for all these reasons, right? That volumes, because my original thought late last year was, demand will come up a little bit, supply will whittle away a little bit, and we'll be in a better place, late this year or so forth. Well, if that is no longer the case, and let's say volumes are flat or down, I think in that scenario, you see a larger drop in supply, and we may end up in the same spot, but just a very different route getting there, right? And the last thing I'll say, before I turn it over to David, is there has been a bunch of shadow capacity in the industry that is hurt. Shadow capacity it takes a couple forms, but the biggest one to me is the U.S. trucking companies illegally using Mexican a B1 visa, right? So Mexican drivers to haul, not border crossings, to haul domestically. I'm telling you, it is happening. Customs and Border Protection will tell you it's happening because they used to see a driver, say, oh, he crossed every day or every other day. Now we don't see him for 3 weeks. You ask them what they're doing. Oh, well, when I get over to the U.S. side, they put me in one of their trucks and they have me start running loads in the U.S. So we think there's going to be a crackdown on this, especially with the horrific accident that was not a Mexican driver over the weekend in Florida with the fatality. But there is a spotlight being put on some of this. I think you are going to start to see that happen as well, where we're going to crack down. The English language will probably provision now out of service will help with that as well. So anyways, that's my thoughts. I would be more than happy to take questions, and now I will turn it over to David.
Thank you, Bob.
Oops, wasn't my, oh, grabbed the wrong way.
Let's see. Okay, good morning and welcome. And thank you to Jordan and Bob for their presentations. I look forward to the Q&A session. But before I start my presentation, I'd like to ask you, by a show of hands, how many people believe that the Fed should cut the policy rate by 25 basis points? Anybody think they should do it by 50? No? Oh, okay, a couple 50s. How many people think that the Fed should not cut rates? Okay. Well, it looks like the 25 basis point cut wins so far. Okay, good, because what I'm going to talk about today, tomorrow's a very important day for Chair Powell. He's given a speech, a keynote speech, tomorrow at 10 a.m. You should listen to it, at the Jackson Hole Economic Policy Symposium. It'll be his last speech as the keynote speaker and as Fed chair. And the significance of this speech is that this speech has generally been an event where the Fed talked about a shift in monetary policy thinking, as past Fed chairs have done so. And Chair Powell could have the opportunity to do that this time as well. Because when you think about it, we have a situation with tariffs, inflation risks, softening economy, weak labor market. This could be the opportunity for the Fed, for Chair Powell himself, to really talk about what's going on and what their thinking is going forward. We have a policy meeting coming up on September 17th. So if he doesn't talk about these issues tomorrow, certainly he will talk about them at least by the 17th of September. So that's what I'm going to talk about in my presentation today. I'm going to talk about the options that the Fed has in terms of its policy decision, and then look at the data that supports actually both sides of the story. And then I'll give my own assessment afterwards. Okay, so I think we kind of covered this a little bit. We know that there's a big tariff shock. I'm going to go through a little bit of the details here coming up. But we have a big tariff shock, 18.6% as of August 7th, so it doesn't include the derivative tariffs that came out after this date. Jordan did a great job talking about the macro backdrop. We have the economy that's marked by weaker growth, pickup in inflation, softer labor market. And so the Fed is at a crossroads. They have a choice of three different options. They can hold, they can wait and see as they have been doing, or they can actually cut the policy rate. So we'll talk about that. Our economic outlook, I'll give you a quick brief here. We revised it up slightly. But we do have wide risk ranges because there's still a lot of uncertainties on the horizon that we have to deal with. Okay, this is my starting slide to kind of frame the whole issue about what the Fed is facing, because what I wanted to highlight here is not only do we have a huge tariff shock, again, it's up from 2.4% in 2024 to nearly 19% in 2025 so far. And it's the highest shock since 1933. And so what I wanted to highlight here, though, is that the shock is just not about inflation. Tariffs are just not about inflation. That's why I kind of put onto the right-hand side of the slide. I talked about what the tariff transmission is. And the two things I just want to highlight here is the fact that consumer prices are affected by tariffs, but so can be the labor market. The labor market could be affected as well. Because if businesses cannot pass through the tariffs to consumers, that means that businesses are going to absorb the costs. And if they're absorbing the cost, they might have to make some adjustments to the cost structure, which could mean layoffs, in order to absorb some of that additional tariff shock. And that means the tariffs themselves have an effect on the Fed's dual mandate. Because keep in mind, the Fed's dual mandate is full employment and stable inflation at the 2% level. Okay, so Jordan already laid out this backdrop. We have a GDP of about 1.1% on the first half of the year at an annualized rate. A little bit of a pickup in inflation, different various inflation measures. And again, a very weak labor market, averaging 35,000 jobs per month over the last 3 months. So the Fed is, as Jordan mentioned, the Fed has a conundrum. They have 3 different options to think about. Okay, the first option could be to hold rates, or maybe even raise them. And we're not going to talk about this one specifically, but the reason they would do this is if the Fed thinks that inflation is entrenched and they really need to get inflation down, this would be the option they would take. They would say, you know what, we're going to hold rates higher for longer. Or we might have to raise rates to get that entrenched inflation back down to 2%. The other option could be wait and see, which is what Chair Powell, or the committee, that's just Chair Powell, it's the committee has been doing. They've been waiting and seeing. They're being a little bit more calibrated, more measured. They're looking at the costs and benefits of both sides of the dual mandate and seeing what's the best move they should make. Or again, they could cut rates. They could say, you know what, the labor market's weakening. And if the labor market's weakening, that means the consumer is weakening. And if the consumer weakens, knowing that consumer spending is about 70% of GDP, GDP has a risk of falling into recession. So that's why they would probably go take the approach of cutting rates. Now, I think Chair Powell, if he talks about it tomorrow or on the 17th of September, he should really answer 3 questions. I think the first question he should ask is the economy weak enough that there should be a 25 basis point rate cut? Let's look at this chart here. This chart here shows what I call core GDP. What I do is I take GDP, I subtract out inventories, I subtract out trade, I subtract out government spending. And I leave what's most important, the most important part of GDP. The most important part of GDP is consumer spending, business investment, and residential investment. So we take out all the volatile stuff, and let's look at what's the core GDP. And we see the core GDP has slowed to 1.3% in Q2 of 2025, down from 3.4% in Q3 of 2024, and then it's the slowest pace in 2.5 years, Q4 of 2022. Now keep in mind, when the Fed started its rate cut cycle, it did so in September 2024. In September 2024, GDP was expanding at 3.4%. 3.4%, they get a 50 basis point rate cut. So if you're getting a 50 basis point rate cut and when the economy is growing at 3.4%, now admittedly, he doesn't know that it was growing, and again, it's not always to blame Chair Powell, but the committee made that decision. And they didn't know it was 3.4% at that point, but even the quarter before that, it was running at 2.8%. So if you could get a 50 basis point rate cut when the economy is growing though at 3.4%, why wouldn't there be a rate cut when the economy is running now at 1.3%? So that's one question I think he would want to address. And because the importance of this, if the economy is growing this slow, because keep in mind, GDP is not the mandate, but what's important about the slow GDP is if the economy is growing slowly, you can't absorb workers into the people into the workforce. So that does affect their mandate indirectly. Okay, second question he needs to answer is, does he see tariffs actually impacting inflation? So I have here, let's focus more on the left-hand side of the chart. Left-hand side of the chart is the blue bars, which are the goods components of CPI, selected ones. The chart on the upper left is the commodity side. It's the aggregate commodity side. And we see here, if there is an impact of tariffs on CPI, you should see a month-over-month spike in the CPI index. There should be a month-to-month spike. We really don't see too many spikes on the good side. Maybe household furnishings probably has the biggest, maybe a tariff impact that we're seeing right now. But if you look at overall the good side, it's growing at 0.2% month over month. That's normal. We get that all the time pre-tariff. So we really don't see much inflation impact at this point going through the CPI index. The third question he should answer is about the labor market. Keep in mind that on July 30th, when he was giving his press conference after the FOMC meeting, Chair Powell said that the labor market is solid or strong. And then 2 days later, we get this very weak labor market report. So we need to know from Chair Powell at this point is whether he does still see that the labor market is strong. Now, if you look back, going back to January 2023, you see here that labor market has been really dominated by 3 sectors: education, health services, government, and leisure and hospitality. 90% of the job gains since January 2023 have come from those 3 sectors. It's these here sectors that really have been kind of left out. And admittedly, yeah, they're probably the more cyclical sectors, probably the more interest rate sensitive sectors. So they could probably benefit from rate cut. If we take overall employment and subtract out the top 3 sectors, this is the chart we get on the right-hand side here. And we see that the monthly gains in these jobs minus the top 3 has only been 19,000 jobs per month. So not very strong job gains. Again, these are the sectors that really support the underlying strength of the economy. We need to broaden to make growth sustainable. It's important to have a much broader job gains going across the board. And these are the more dynamic sectors that should be growing more strongly and supporting the economy. And then the survey data actually supports the weakness that we're seeing in the labor market. You look at the Conference Board data on jobs hard to get, that's been rising, so people are finding a hard time to get a job. ISM employment indices are in contraction territory. And small businesses are showing that they don't have a plan on hiring over the next 3 months. So the amount of hiring is going to be pretty weak still going forward. Now, what would Chair Powell say in support of the wait-and-see approach? Well, one thing he can support, one thing he can point to is retail sales spending. This is good spending. This is really all a goods component because it's retail sales excluding food services. This is inflation-adjusted data. And what I did here is I took the pre-pandemic trend and I extrapolated to July 2025. And we see here is that retail sales spending is actually moving right along trend. All right, I don't see any it's not like going strongly above trend, or nor is it weakening below trend. It's just growing right at trend. It's just average spending. And what I pointed out here too, you might see these little orange lines here. These orange lines are periods of time when retail sales spending on an inflation-adjusted basis was flattening out. And you notice that they all flatten out prior to the economy falling into recession. So it's like the point where you're at the end of the cycle, consumers are getting exhausted. There could be other reasons why they can't uphold their spending levels. Some might be losing jobs. And so that usually raises a red flag that when retail sales spending starts to wane, that there is a risk of a downturn. You don't see any signs along here that there's any sideways movement of retail sales. They tend to be going quite strongly at this point. So that's one area where he could point to in support of wait and see. The second point where he could say wait and see is that you look at the inflation, the risk, the future risk of inflation. What I did here on this chart in the orange line here, what I did is I took the ISM prices paid indices for services and manufacturing, and I created a composite index. I took the weighted average of the 2 indices, and I made that an index, and I compared it to the PCE price inflation. You see they match up pretty well. In fact, since late 2021 to 2025, there's been a more than 90% correlation between the 2 time series. And the PMI, the ISM composite index here, actually gives a 5-month lead to what could happen to inflation. So what the index is telling us is that, yeah, there's some upside risk to inflation over the next 5 months. It's actually pointing that the PCE inflation could rise as much as 4% year over year. And if you look at it, given this close correlation, keep in mind that the ISM numbers have actually been undercalling the actual inflation rate. So it could be even though maybe slightly higher than the 4%. The other point, keep in mind too, the other point is that in 2021, in congressional testimony, Chair Powell said that inflation was transitory. He said, what's happening with inflation today, back in 2021, it's going to come back to 2%, It's just transitory, don't worry about it. We don't have to act on it. But sure enough, what happens is that the rate of inflation actually doubled a year later. So the Fed has a little bit of a scar on its credibility for that. So the Fed is going to be a little more cautious about wanting to make sure that they get it right. They don't want to make a move only to have to reverse themselves if inflation spikes up again. And then the other thing that Chair Powell, he says this quite often, he says, the thing is the Fed they have one tool. They have one tool in their toolbox, and that's interest rates. Yet they have two goals. So they have to meet two different goals. One goal is full employment. And look at, they're actually meeting their full employment goal. Unemployment rate today is 4.2%. Full employment is defined as between 3.5 and 4.5%. So they did reach their full employment mandate. But look at inflation. Inflation's at 2.8%. Their target is 2%. So they're not meeting their inflation mandate. So what Chair Powell has said repeatedly, he says when you have one tool and two goals, and if you're meeting one but not the other, you have to direct your attention to the goal that you're not meeting. And that's inflation. And this is why he said that inflation at this point should be modestly restrictive in order to achieve their inflation target. So now, based on that, so you have the two sides. You have the wait and see, you have the rate cut, and you see all the data. The evidence supports both approaches. So what is the financial market saying at this point? Financial markets currently are saying that, again, if you look at what happened on August 1st, this is the first blue bar. These are the meeting dates that are coming up for 2025. You see that when the poor data came out on employment, the probability of a rate cut, 25 basis point rate cut, spiked to 80%. And then even when the CPI and PPI data that came out afterwards came out, it was at 90%, more than 90% probability of a rate cut. So again, they agreed that, hey, we don't see any inflation coming through CPI, employment is weak, go ahead and cut rates. Now, admittedly, when the retail sales data came out on the 15th, it went down a little bit because, yeah, the consumer seems to be doing quite well. So we have to be careful not being too aggressive with rate cuts. Because again, it's really, in a sense, a little bit of a balance on both sides of the decision-making process that the Fed has to make. Now, here's an important chart, and because the thing is that the bond market acts as checks and balances on the Fed, and given that there's not many checks and balances we see today anymore, I think it's at least important to know what the bond market can do to the Fed if the Fed makes the wrong decision. If you go back to that September 2024 rate cut, you see the bond market was admitting that, yeah, there was some weakness. What was happening, the growth was 3.4%, but what was happening is that unemployment was increasing. It went from 3.5% to 4.2%. And unemployment has a way of being nonlinear. It could spike up quicker than you might think. And the Fed didn't want to be caught by surprise by that. So they did cut by 50 basis points. But what happened is that the bond market didn't like it. They thought that the 50 basis point was too aggressive. And then subsequently what happened is the bond market said, you know what, we're going to actually increase the bond yields. We want the risk was if you're too aggressive, you might reignite inflation, which means that the inflation expectations going forward means that bondholders want more yield. They want compensation for the fact that inflation might be reaccelerating if you cut too aggressively. And sure enough, the bond yields, they go up. And the critical point of the reason of this, we talk about the housing market. Jordan talked about the housing market being in recession. What you don't want is the 10-year bond yield to increase. If you want a recovery in the housing market, which would be great for the trucking industry, you want to keep that bond yield lower. So the Fed has to be careful. They can't go with a 50 basis point rate cut and thinking that everything's going to be okay. So this is what's critical here. Now I have a summary slide, but I want to end on this. This is my last chart here. And what this chart is showing here, this is a buying sentiment from the University of Michigan data. It looks at the bad time to buy for different spending areas, such as new vehicles, homes, and household goods. It shows that whether people are saying it's a bad time to buy because of prices or interest rates. Now, the point I want to make with this chart is that again, when people talk about tariffs, they say, hey, don't worry about tariffs, because what's going to happen, it's going to be a one-off price increase, and then it's going to be transitory inflation after that. And what this chart is telling me is that households, they don't care about transitory inflation. They don't care that inflation might be transitory. Because look what happened on this chart. If you look at this chart, you see that, we all know that inflation spiked or reached the peak in 2022. And it was at 9%, CPI was at 9% in 2022. And it did fall below 3%, quite recently, okay? But you would think that if they cared about inflation, if households cared about inflation, you would think that the prices component would be back down to the pre-pandemic level. But no, households are concerned about price levels, not about the rate of increase in prices. Price levels is what's more important to them. This is why they're still stuck. They're still saying, you know what, prices are still too high across the board. And because they already experienced that one-off increase in price from the pandemic. Now the tariffs are going to go ahead and do it again, and just say, oh, don't worry about it because we'll have transitory inflation. The households are already facing an affordability crisis on the housing market, and that we're only going to exacerbate the affordability issue by implementing these tariffs. So yeah, the Fed could go ahead and cut interest rates, which is good for this component of consumer sentiment, but it's not going to help them at all. Because lower interest rates, when prices are going up, is the higher prices are going to more than offset the benefit of the lower interest rates. So my conclusion is our forecast for 2025 and 2026, we're looking at 1.6, 1.7, slightly below what Jordan is looking at for Eaton. In 2026, we're at 1.7, they're at 2.1. We both agree with the idea that inflation is going to be above target. We see a little bit more weakening. We see this is on a quarterly basis. We see unemployment peaking at about 4.9% before returning to full employment at 4.5. If it looks like we're in agreement, we do see 25 basis point rate cuts, 3 of them this year, and additional rate cuts in 2026. I kind of erred a little bit. I meant that when I say policy rate 150 basis points lower in 2026, that's cumulative. So again, we had 75 basis point cuts for 2025, another 75 basis point cuts in 2026. And then again, I just want to emphasize we have these uncertainties on the horizon. I want to emphasize, I think it'd be really important if you have the opportunity, 10 o'clock tomorrow morning, Chair Powell will give this speech, and let's see if he does respond to these issues. And I think if I were Chair Powell, and if you were going to talk about these issues, I think the key point to say is that I do recognize that there is weakening in the labor market, and that the Fed, that we are moving in the direction of a rate cut. But I would be more cautious and say we're taking this one meeting at a time. I would communicate this as saying, yeah, we're going to cut rates, but it does not mean we're looking at a string of rate cuts. And I think at least that type of communication would keep the bond market a little bit more at ease, not thinking that the Fed is going to be too aggressive, especially against the backdrop of tariffs, because we've seen what happened in the past. So that's my conclusion, and I look forward to your questions.
Please join me in, I think I'm, oh, there we go. Please join me in giving another round of applause to our panel that really did a superb job. So thank you, David. Thank you, Jordan. Thank you, Bob. I'm going to exercise the prerogative of the moderator by asking the very first question. But for those of you inquiring minds, if you could start raising your hand so that we can get microphones to you. Like I say, I'll kick things off, and then we'll turn things over to you all to fire your questions at our panelists. So, and I think I'll victimize Bob first, but you know, this will go through the full round in response to this question. Bob, you've seen a number of trucking cycles. You indicated in your presentation that you think we'll get back to supply-demand balance by an exit of capacity. But we've been talking about a 3.5-year freight recession. So what does it take to end the freight recession? And if you care to assign a date to it, do you think there's a good possibility that the freight recession will end in 2026? So you're on, and then we'll ask for our other panelists to venture their thoughts. Go for it.
All right. That's a hard one to answer because these guys brought up some really good points around, uncertainty around policy. I am definitely in the more bearish camp around tariffs, right? You tariff goods, not services. I think we are in the early stages of seeing inflation around that. I think David brought up an excellent point, and I bring this up all the time. Yes, inflation is still too high, but when we had the election, that was the number one issue. But what I would say is voters got inflation and prices mixed up. Inflation rates came down. They're still more than the Fed would like to see, but it went from 9% to high 2s. But what didn't come down were prices, and that is and that University of Michigan data shows that. So, I guess a long-winded way. I honestly think the way that the industry is going to get healthy is around supply exiting, not because we're going to see a snapback in demand. I'm not saying demand's going to fall off a cliff either, right? But I don't see this sort of really strong recovery in demand coming. Now, at the end of the day, if there's the same amount of demand, maybe a little bit more, maybe a little bit less, but there's fewer carriers going after them with less equipment, well, of course, then those that are left will benefit.
Thank you. David or Jordan, you want to step forward? And you don't have to literally stand up, but give us your thoughts.
You want to go ahead? Yeah. Again, I agree with what Bob is saying. I think it's very challenging because, again, the tariffs are the big headwind, and to get behind that, for us to get back to a freight recovery, you need to get consumer spending back. And without consumer spending coming back, and it's going to be sluggish, it's going to be tough because, again, higher price levels, you're squeezing the amount of people who are eligible to buy goods. I talked about this before at a prior seminar. You could think about income distribution. And when your prices levels go up, you're actually squeezing the amount of people. You're actually removing certain amounts of the people in the income distribution that won't be able to afford a car, won't be able to afford a house, which means all the downstream effects are from appliances, carpeting, all that stuff goes away. You can't get that. So it's going to be a very sluggish recovery back on the freight side. And I can't put a date on it.
Thank you. Jordan?
And yet, your chart that you showed, which I really liked, on real retail sales, is still continuing upward and onwards despite that. My focus would be on the housing market. We really need to get the housing market moving. Right now, it's just stuck. Right? We have so many people with low-rate mortgages that can't move, and then the new housing market's not doing anything. But even the existing sort of turnover in the existing housing market, where people upgrade and buy appliances and so forth, that generates a lot of freight, is not happening. So in my view, we need interest rates to fall to get the housing market moving, and that could be a catalyst.
Yeah, can I follow up from, Jordan made an excellent point, because I did show a chart that had retail sales going up. It's trending upward. Looks like consumers are doing average. See, my concern, what I do when I think about consumer spending, a lot of people talk about the ability to spend and the willingness to spend. Well, actually, it goes beyond that. There's actually two more motivations for spending. The other two motivations for spending is the opportunity to spend and the need to spend. So now, if you needed to buy a car because you have replacement demand, that's more of a need to spend. So you're going to buy a car because you need to get one because yours broke down, something of that sort. Or the opportunity to spend. If you want to spend because you don't want to pay higher prices later because of the tariffs, you're going to pull ahead your spending. So some of that spending, Jordan's absolutely right. Some of that spending could be the need to spend and the opportunity to spend playing a role there. And then that's why we'll have to see down the road whether the consumer, the retail sales spending starts to level off, which then raises the red flag. So there are other reasons for why people might need to spend. And it's looking right now, it looks like their trend spending is pretty good, but it's because of other motivations to spend.
But I would add one thing. Fed cutting the Fed funds rate, that's short-term interest rate. I don't know that the long-term interest rates, which is the mortgage rate, will go down.
And that's what we saw last year. When
Right.
the Fed cut, mortgage rates actually went up.
Right, and so that would be my concern, like that. I don't know that it will get you what we're looking for because of all these other factors. I totally agree with you guys, but that's my concern, that I'm assuming they're gonna cut at some point here, but that we're not gonna see the long-term interest rates go down as much.
Yeah.
Excuse me. And as a former economist, I'll put my oar in the water on this one, which is I think it'll take both a housing recovery, as Jordan pointed out, and a manufacturing sector recovery. So when that happens, then we'll get a freight rebound. You know, there is an issue with regard to, does President Trump's policy result in a revival of the manufacturing sector? And I'll say at the very least I'm an agnostic on that one. So let's look out, inquiring minds. Do we have a raised hand
Got a
and
question over here,
microphone?
Jim.
Thanks very much for your presentations. Excellent, all three of you. Bob, I couldn't agree with you more about the shadow capacity issue. And it's been kind of the dirty underbelly of the industry for a long time. And we're way past overdue, you know, taking a look at it and putting a spotlight on it. If you had to hazard a guess, what percentage? I mean, the thing in Florida, absolute massive tragedy for that family. But, you know, if we're going to move this issue forward, unfortunately, things like that have to happen in order for people to get really focused on it. If you had to hazard a guess as to what percentage of the driver capacity out there is either fake CDLs, invalid CDLs, you know, English language, evidently that driver failed 8 out of the 10 points on the English language roadside, you know, evaluation. What percentage of the drivers out there right now, if we had all the enforcement resources, you know, available and possible to really crack this down, would that be enough to really force freight rates higher? If we eliminated that, whatever that is, 10%, 15%, what do you think that would do?
So it's a great question, great point. And here's the challenge of answering this, right? And that is, if you go to fleets and you say, hey, how many of you are using illegal, you know, B1s? They're all right. They're not going, boo, I'm doing it, right? And nobody wants to admit to it. I think it's a fringe. Well, we know it's fringe. It's illegal. The vast majority of them have to know it's illegal. But so instead of putting a number on it, let me just give you a couple anecdotes that I've done around this. So first of all, I was in Laredo a little over a year ago. Met with some high-ranking officials at the World Trade Bridge, and I said, hey, listen, I'm hearing from my members that they think there's this illegal capacity going on, you know, by fleets on this side of the border using the B1s to haul this freight. What do you think about that? And the CBP, if you deal with CBP, these are pretty conservative folks, right? They are not, and they're like, oh, it's absolutely happening, which really threw me back. And it got to what I was saying earlier. They're like, we would see Bob cross the border every day or every other day, and now we see him every 3 weeks. And when we ask him about it, when he comes across, he tells us this. Now, they can kick him out of the country right there, but they feel like the drivers are being coerced into it, right? You just make a delivery over there, and they feel like they're being coerced into it. So, you know, I also have been to a lot of shipper groups where I bring this up, and the shippers come up to me and go, hey, thank you for, like, I didn't know when a fleet came to me and I said, why are you cheaper on rates? And they're like, because I'm using B1s. I just thought it was something they could do in the industry. I didn't realize it's illegal, right? And by the way, some shippers are going to fleets and say, you need to come down on rates, just use B1s like some of our other carriers are doing. And even though it's not international loads. So, you know, is it hundreds? No. Is it a few thousand? No, it's more than that. I don't know. Like it's hard to say, but you add all this cumulatively in addition to, we were seeing violations in the database of around 8,000 per year for English language. It's just that it wasn't for the last few years. It's just that it wasn't our service. Now, that also doesn't mean that each one of those was a separate driver. That could have been a driver getting pinged multiple times during the year. So, you add this up, it's not insignificant, right? Now, does it solve everything tomorrow? No, but it's an important step of getting this under control. It was a good point.
Another question.
Part of the Fed's mandate is governed by how they feel about the labor market, full employment. And I understand that recently the BLS reporting is going to be changing from monthly to perhaps quarterly. And I want to know, and also the appointee is, let's say, political. I want to know where that intersects with the choice of the Fed to wait and see if the data that they receive on employment goes from monthly to quarter and maybe less dependable.
Yeah, it's a very good question, and what it's going to do is going to make the Fed's decision making much more complicated. Because if you're only getting the data quarterly instead of monthly, again, keep in mind they have 8 meetings a year. Okay, so if you're looking at 8 meetings a year and only four employment reports coming out, it's going to make it much more difficult for them to make a good decision. And there's not much better data out there than really the BLS data. It's really the BLS data is good data. All right, sure, there's revisions and there's been problems about the reporting from companies that are reporting the data and the delays. So that's why they're given 3 months. That's why there's always 2 revisions in the month. It's because it's the delays of the reporting by the firms. And so it's going to make it much more difficult for the Fed to actually make a decision. And they'll have to, if they had to make a move on the policy rate and the labor market's weakening, yet they're not getting the data in a timely manner, it could actually make the economy worse off. And so I think that's the key challenge for the Fed. Now there are some like ADP, private data out there as an alternative, but nothing could ever substitute for what we have right now currently with the BLS. Now, like I kind of hinted to today, looking at the GDP data, which is produced by the BEA, and like I said, what's important about the economy itself, the economy is not growing. That should give you some indication that it's going to be much more challenging labor market. So you could also use BEA data that comes out, consumer spending data comes out monthly, where the GDP again also comes out quarterly, but at least you might have more real-time data on consumer spending behavior that might influence economic activity, which then might affect or give some indication about what's going on with the labor market. So the bottom line is it makes it very difficult for the Fed to make a timely decision that could prevent the economy from actually tipping into recession if they're not catching weak labor data in time. Does that answer your question? Yep, okay.
Next question. There we go.
If the tariffs end up working out for the administration and they declare a victory, from your vantage point, what does that look like? How long does that take to kind of bleed out and work for the broader economy?
Well, first of all, how do you define success of the tariffs is important for me to answer that question. Because I see, right, because my point, I guess, or my point or my bias is that I already communicated that I think tariffs are going to be bad for the consumer. So I don't know really where the government's going to win, because I think personally, this is why I do support the rate cuts. Okay, because if you have the rate cuts, could rate cuts make the inflation from tariffs worse? Well, that's the theory behind it. Yeah, the answer is yes. Because keep in mind, tariffs is a supply shock. So if you think of supply and demand, you're shifting the supply curve to the left. So you're hurting 2 things. You're making inflation higher, and you're making the economy weaker and labor market weaker. So the idea is if you cut the policy rate, that gives the idea that you're pushing the demand curve then to the right, which is going to only exacerbate inflation. But my point is that I think there'll be more demand destruction because households will not be able to afford the tariffs. They won't be able to afford, if you try to pass on the tariffs to the consumer, they're not going to be able to afford it. You know, okay, especially in the weak labor market. Now, I think the administration thinks the success of the tariffs would be that we balance trade against our trading partners, we bring back manufacturing, reshoring, and that we bring in this more revenue that maybe we can actually cut taxes further. Those are, I think, what the administration would call win-wins, is what I would think that what they're trying to achieve. But I don't think they will be successful doing it, because I just don't see all that positiveness coming out of it.
No, I too am bearish on it as well. I just don't see the other side, and I want help seeing what they're seeing, and I don't get how it plays out positively. So you answered my question. I appreciate it. I just am looking for a little guidance on what the other side is seeing that I don't understand.
I really, working in DC, and I do trade policy, it's as simple as they think the US, you know, we're the second largest manufacturing economy in the world, second by far to China, but they think we should be right up there with China. And they have this idea in their head that by doing this, we are going to be a even bigger superpower in terms of manufacturing. The problem with that is the costs of tariffs hit relatively quickly. We're still in the early stages here. I would also argue that if you look at the CPI and pull a layer back, you would have seen in this last report that durable goods CPI went up at the fastest pace in quite a while. And the year over year, sequentially, and year over year was the highest since November of 22, even though it's much lower than overall CPI, right? But it is accelerating. And that's where it's hitting. But anyways, the cost of tariffs hit quickly. The benefits of any tariffs take years to develop. So I agree with you. I don't know what the end game is here because I don't see them coming in, especially the IEEPA tariffs. I don't want to get into all this, but the IEEPA tariffs, those are easy to put on, put off. But you start doing Section 232, 301 investigations, those don't come off overnight. If they all of a sudden go, uh-oh, right? You got to do another investigation. So some of these are much more permanent and are going to take longer. So this is why I'm more bearish about some of this stuff, because I think, you know, I think it's going to start to hurt, and I think reversing it is, I don't know that they're going to be willing to do that.
Another question?
Takes a second. All right, the question that I had, you're touching it, and you asked it yesterday to the OEMs, are the tariffs here to stay?
I think that they are here to stay for the next, year. Well, listen, I think midterms are very important in all this. So until the midterms happen, yes. I think this is why the president wants a different chairman of the Federal Reserve, because I think he sees that if we get more aggressive in cutting, that it will help offset some of this stuff. Yeah, I think at least until midterms, a lot of this, and I don't think it's done. I think there's more coming. There's more tariffs coming.
Yeah, no, that's true. There is more tariffs in the pipeline. Semiconductors, pharma, other areas. Whether they are, it's a good question. Whether I think tariffs are going to be permanent. I would like to think that, that tariffs are going to be permanent. I'm trying to think beyond just the Trump administration. All right, because I'm trying to think beyond that. Because you look what happened when the Trump implemented tariffs on China in the first administration. Biden did continue them, okay? But I think that Biden's motivation, I think, was more strategic than just saying that I want to punish a country or equalize trade or just bring manufacturing back. I think it was a little bit different motivation. I would like to think that, let's just say there's a change in administration 4 years from now, I would like to think that the tariffs would not be permanent after that, especially against our allies. All right, maybe, I think there's always going to be some probably tensions between US and China down the road, and they'll want to keep some tariffs maybe on China. But I think, I would like to think that they would not do so for especially our European allies, other countries who are allies and long-term friends of ours, that I would think that they would take them off. But that's just my own personal view.
I'd add that there's also a non-trivial probability that IEEPA tariffs get struck down by the courts, and that could be another shock to the system in maybe a positive way. Going back to the last question, sort of this kind of touches on it though, is I do think that industrial policy has changed dramatically in the last 10 years, and there is a shift by both political parties. You saw it under the Biden administration with the Made in America provisions in the infrastructure bill, the CHIPS and Science Act. There is a push from both administrations to make it in America. And Eaton is a domestic manufacturer. We do a lot of manufacturing in the U.S. Our preferential location was not in the U.S. 10 years ago. Today, it would be in the U.S., right? And so Trump's going about it in a different way than Biden administration, certainly, but the end goal of make it in the U.S., we think is here to stay, and is going to result in a lot of investment, and we're already seeing that today with manufacturing investment 3 times what it was, pre-COVID. So.
My question would be on the fleets exiting the market. So let's say at some time in the future, we have the spot rates going up because now we have fewer carriers or fleets going after the freight. My first question would be, would there be appetite for the small players that have exited the market to jump back right in? Secondly, how easy it would be for them to just go ahead and lease a truck, and then we are in a similar situation where we have, again, more number of fleets than the freights, or players than the freight?
Yeah, it's a good question. I mean, this has always been a relatively low barrier to entry industry, right? Get a CDL, get a truck, however you get it, and you're essentially in business. With that said, I do think that the barriers to entry, while still low, are rising. And so, yes, that is a risk. But I don't think with the current cost structure the way it is, both for equipment, but other things, liability insurance. We heard about it yesterday. Everything you heard about lawsuits in the industry, that was absolutely true. I mean, it is out of control. I can tell you, I deal with Canadian fleets. They are scared to death when they're operating in the U.S. Because they don't see anything like that in Canada if there's an accident. Yes, I think it's maybe a little bit in between. I'm sure there would be some that would come back if rates went up enough, and so forth. But I also think it is just because of some of these cost structures and what's going on with regulations in the industry around the drivers and so forth, that at least it's a little bit tougher, maybe not tough, especially relative to some other industries.
Okay. My question would be, you guys have laid out a great examples of what it would take for this to happen through this. And every time we keep hearing the uncertainty word is what's keeping us in there. What would the scenario look like that says we now have certainty? Does anybody have any thoughts on that?
What is certainty?
Yeah.
Well, I guess in one sense, I would say if the administration came out and said, and did, because I think there are more tariffs coming in the pipeline, but at some point here said, it's over, we're done, tariffs are in place, we're not doing any more. That gives you certainty, but I would argue, you know, again, levels we haven't seen since the 1930s, that's not very, I guess the certainty part is helpful, but the level of the tariffs are not. So it really depends around, you know, what we're talking about, but in that case, I would say, well, yeah, okay, certainty's nice, but I think we're still in a slow growth environment because of these high tariffs.
Yeah, I would agree with that. Again, certainty, there's always going to be a range of uncertainty. We like to obviously narrow that range of uncertainty. But the thing is, there's so many, under this administration, there's been so many areas of uncertainty, whether it's trade, whether it's fiscal policy, you know, the impact on the budget, climate type issues, immigration. I think the problem is that all the different areas of uncertainty have widened so much that it's very challenging to get to a better clarity. But like Bob is saying, or you might know everything that's going on for all those areas, whether it's climate, whether it's immigration, trade. I still think it leaves a very complex environment. It's been an environment that we weren't used to, you know, before January. So I think there's always going to be some underlying tensions to have to deal with to move forward in a more stable and sustainable way.
I'm going to try this question on our panel, especially ACT Research as being a major data provider to the industry. But let's talk about data for a minute. Is there a data quality problem in the Washington statistics mills today? Is there a potential for a data problem in the future? And one side question I'll direct to Jordan. Do the Washington data mills do a good job in capturing the dynamics of the technology sector?
Yeah, so working for a private company with, you know, large budgets for data and importance of data, especially as we think about AI applications, we're increasingly buying private sector data. More and more private sector data because we don't believe in the quality of the statistics that are coming out of Washington. You know, the BLS and the employment survey, sure, it might be the best that the government has, but you know, they're still doing that by phone. I mean, that's sort of unbelievable in this day and age. We would hope that they would be, you know, investing heavily to kind of up their technology, but so far, you know, their budgets are being cut, and that's not happening. In terms of measuring data from the high-tech industry, no, it's poor. Again, we rely on, you know, private sources in the data center space to really get a good assessment of what's going on there.
And do you think it is an underestimate, net? In terms of, you know, the mismeasurement out of Washington, do they underestimate the output of the technology sector?
That's a good question. I don't know. I just don't think they're measuring it accurately at all. And so I'm not sure whether it's overestimating or underestimating, but. Yeah.
Bob?
Oh, on that piece, I wouldn't venture to guess. But the reality is, you know, a couple things just come to mind. I mean, one is, yes, have we had issues for the last several years of the data not quite as good as it used to be? Sure. It's still it's still the gold standard around the world. DOGE cut these budgets, cut these employees, so that doesn't help with that. And if all of a sudden we don't have as reliable, maybe it definitely can be better, I won't disagree with that, but if it gets worse or less frequent, you think people are going to want to invest in the US? You think people are going to want to, you know, I would say it's going to have the opposite effect. I think one of the reasons why people do like to invest in the US is because they rely on this data and they think it's good. And this is going to hurt it.
David?
No, I totally agree with Bob. Because again, the data is the gold standard, and I don't think there's anything wrong with eventually having private data, but I don't think private data will ever be able to compete with the breadth and depth of data that the government does put out. I think it really is good data. Sure, there are problems, absolutely, and that's why I think the approach of how this whole firing of the commissioner was just done so poorly. I think they could have more or less been more intelligent about it and say, yeah, there are some problems with how we collect data, and we should get a committee together, find out how do we do it and how we do it in a better way. That would have been a much more better way of approaching it than just to fire someone and then totally now make it more politicized. And so that's unfortunate.
So with that, I would like you all to join me in thanking Jordan, Bob, and David for getting our day off in a terrific kickoff session. Gentlemen, thank you very much.